Let's break down where your money goes when you invest. Both ETFs and mutual funds are baskets of investments, stocks, bonds, or other assets, letting you own a slice of many companies at once. This gives you instant diversification, so you're not betting everything on one company. Mutual funds are the classic option. A professional manager picks and chooses investments, aiming to beat the market. You buy shares directly from the fund company, and the price is set once a day after the market closes. It's hands-off for you. The manager does the work. ETFs are the newer option. They usually track an index, like the S&P 500, and are mostly managed by algorithms, not people. You buy and sell ETF shares on the stock market, just like regular stocks, and their prices change throughout the day. Think of a mutual fund as hiring a personal shopper, while an ETF is like buying a pre-packed meal kit that follows a set recipe. Both give you a mix of investments, but the process and level of management are very different. Understanding these basics is the first step to smarter investing. ETFs and mutual funds work very differently when it comes to trading. Mutual funds are bought or sold directly from the fund company and only at the end of day price, no matter when you place your order. This means you can't react to market news in real time. You get the closing price, period. It's designed for long-term investors who don't want to trade actively. ETFs, on the other hand, trade on stock exchanges all day long. You can buy or sell them instantly at whatever the current market price is. This flexibility lets you react to market moves, set limit or stop-loss orders, and manage your risk in real time. ETFs are ideal for investors who want more control and transparency. Mutual funds are better for those who prefer a set-it-and-forget-it approach. The choice depends on how hands-on you want to be. Fees can make or break your investment returns. The main fee to watch is the expense ratio, a yearly percentage of your investment that covers the fund's costs. Actively managed mutual funds usually have higher expense ratios, often over 1% per year, because you're paying for a manager and their team. Over decades, these fees can eat away thousands from your returns. Most ETFs are passively managed, so their expense ratios are much lower, sometimes as little as 0.03%. That's just $30 a year on a $100,000 investment, compared to $1,000 for a mutual fund. Some mutual funds also charge sales commissions, called loads, when you buy or sell, sometimes up to 5%. ETFs don't have loads, and most brokerages now offer commission-free ETF trading. Always check the fees before you invest. They add up more than you think. Lower costs mean more money stays in your pocket. Let's compare ETFs and mutual funds head-to-head. ETFs trade all day on stock exchanges, with prices that change every second. Mutual funds are priced once daily after the market closes. Most ETFs are passively managed and track an index, so they're cheaper. Mutual funds are often actively managed, which means higher fees. ETFs are transparent. You can see their holdings anytime. Mutual funds only disclose holdings a few times a year. ETFs have no minimum investment beyond the price of one share, and you can even buy fractional shares. Mutual funds often require $1,000 or more to get started. ETFs are flexible and accessible, making them popular with new investors. Mutual funds are better for those who want a professional manager and don't mind higher costs. If you want control, low fees, and transparency, ETFs win. If you want a hands-off approach and believe in active management, mutual funds might suit you. The right choice depends on your goals and how involved you want to be. Know the differences before you invest. Choosing between ETFs and mutual funds depends on your style and goals. ETFs are great for DIY investors who want low costs, flexibility, and real-time trading. They're perfect for building a diversified portfolio with minimal fees. Mutual funds are better if you want a professional to manage your money or if you prefer a hands-off approach. Many investors use both ETFs for broad market exposure and mutual funds for specialized strategies. Always check the fees and understand what you're buying. For most people, ETFs offer the best mix of cost, transparency, and flexibility. The key is to pick what fits your needs and helps you reach your financial goals.